Is Bruceprofits. It has been a while, but I'm back with a profitable day. So for today, I was mostly using the unicorn model and at some point I did also use the turtle soup model. I ended up plus $1,500 on a day, but for the most part, I'm very happy that I'm back to trading my old ways, and soon I'll be trading all of my accounts again and activating some other pools that I actually have not been using. I have been going through a major drawdown trying to adapt my model. For some reason, I was trying to change what made me successful over the last 12 months. But I actually decided to go back to the way I was trading. Essentially, I was trying to convert to Dave Teach's model instead of trading ICT concepts completely, but it just messed up my view on the market, so I've now gone back to trading ICC concepts only. I do appreciate the attempt that I was making to maybe simplify my model. But in all reality, what came second nature to me is this model, so I'm going back to it, which is basically trading a market maker model. So trading from original consolidation down to a level up by our sell side liquidity, essentially, or level of liquidity, and then from they're taking trades such as Turtle Soup Unicorn 2020 to model in reverse back to target that original consolidation.
This is a market maker model. As you can see in the top left corner is the original consolidation, and then price eventually breaks lower towards the sell side liquidity or buy side liquidity. And that is where there's an initial turtle soup entry and then unicorn entries. I'm going to circle the entries so you will be able to see them shortly. But essentially, once you get some consolidation, that's going to create energy for a move to occur, and I'm usually trading, back to that original consolidation. So you can see those blue circles kind of circling the turtle soup entry and the potential unicorn entries. Now, I'm going to go into more specifics on how to get into these, but essentially, turtle soup, you're basically entering on the run of liquidity, and then the unicorn, you're entering based on a breaker block and a fair value gap. Could be an inverted fair value gap or a fair value gap. Since I didn't use candlesticks, you can't see the fair value gaps essentially, but what you can see is that the unicorn entry should come, after the turtle soup, and the turtle soup should be the first possible entry you'll be able to take. Now, turtle soup is something where you're going to have to manage your risk very effectively. You're going to have to know to put your stop based on a higher time frame liquidity point or simply a standard deviation. And then for the unicorn, the stop can be the lows or the candle, the breaker, or the fair value gap low. So this model is basically market maker model, and I'm telling you the two entries I prefer, which is the turtle soup and the unicorn model. So this is all you need to get bread and butter setups every day. You need original consolidation, and you need to purge buy side or sell side liquidity and look for either a turtle soup or a unicorn model or even a 2022 model. You can even use the Fibonacci to get an OTE level. And technically you could use the breaker as well. Turtle soup is a run on liquidity on 2 time frames. So for me, I'm usually looking at a higher time frame level or drawn liquidity, such as previous day's high, previous day's low, London high, London low, New York high, New York low, Asian high, Asian low. So session highs and lows. In this example, you can see, let's say, the low that was purged, that pink line, it could be London low, and then you're looking for buys on it, and there'll be a fair value gap that lines up. Now, it might be an inverted fair value gap or a regular fair value gap. Now, you're going to have to do some study to understand what fair value gaps are, but for turtle soup, essentially, once you purge a level of liquidity, there's a potential for an entry. So it could be on a lower time frame, higher time frame. Combining them makes them a lot stronger. So a run on a 1 hour, and then another run on a 15, and then you look on an entry, look for an entry maybe on the 5, or run on the 15, run on the 5, and an entry on the 1, which is preferably something I would do or close to what I would do. So I scalp. So if you want to be a scalper, you're going to want to look for run on liquidity on higher time frames, and then enter the mean reversion trade or even the continuation trade on the lower time frame. But that is how I trade the turtle soup. So looking for one of those PD arrays to occur. Here's the unicorn and plus.
The next model is the unicorn model. The unicorn model is a fair value gap and a breaker block combined that can be an inverted value or a regular value. A fair value gap is simply a 3-candle pattern where the first and third candle do not overlap, leaving a gap in the second candle. Once that second candle is retested, there are potential for entries. If that candle's invalidated, that is also potential for entries. But an invalidated for value gap is called an inverted for value gap, so pay attention to gaps within the market. Additionally, a breaker block is the last set of down closed candles in an uptrend, or the last set of up-closed candles in a downtrend. I repeat, a breaker block is the last set of closed candles in a downtrend and the last set of down-closed candles and uptrend. Once those set of candles are broken, that indicates a market structure shift that validate the CISD or the change in state of delivery. According to what I believe ICT to have taught, everything that I am speaking about is related to ICT market maker model, is related to ICT these draw on liquidity, which are very important. Previous day, high previous day, low London, high London, low Asian, high Asian, low high in New York. These are all based on Michael's teachings. The unicorn model, it made me 6 figures, so I'm very familiar with how powerful the unicorn model is. Stop trading it, but now I am refocused, and I believe I have got a better grasp on the market. The keys again are understanding what levels are important, what levels are driving the market, avoiding specific news events. You want to know that the news is the catalyst, but you want to avoid it because you're basically trading like a casino. If you're trading within the news also, you need to understand how to manage your losses. Once you lose, you should have your risk. I repeat, you should have your risk. That way any further losses will be less than the initial loss, and it'll be easy to recover. So again, do not over-leverage, focus on risk management, and don't get confused. In trying to trade many different strategies, I would say study ICT concepts, and just stick to those. Unless you've already mastered something else, just stick to that. Don't lose your edge, just focus on your risk management.